Hello and welcome to Moneylife News and Views. I'm Debashis Basu. On March 10th, India loosened the rules governing foreign direct investment from countries with which it shares land borders. Now, there are only a handful of countries like Pakistan, Bangladesh, Nepal, and China. And this regime, known as Press Note 3, was introduced in April 2020, ostensibly to prevent opportunistic takeovers during the pandemic. And which country would be able to do opportunistic takeovers in India, except China? Well, the Press Note 3 was directly aimed at preventing China from investing in India. The latest relaxation allows investors with a non controlling stake of up to 10% to use the automatic route dispensing with the prior government approval, just 10% stake. Officials say the change will improve the ease of doing business, boost inflows, and deepen integration into global supply chains. Is China interested in coming into India at a 10% stake with all of the problems that it entails? No. This is all wishful thinking, which the government is saying, which is boosting inflows, deepen integration into global supply chains, and so on. Chinese FDI does not consider India an attractive destination. But China does consider India very attractive. For what? As a huge export market for its products and for dumping. On April 8th, the Chinese ambassador to India, Zhu Feihong, posted on X, "Glad to know that China has become India's largest trading partner in FY 2026 for the 11th straight month. Why won't they be happy? Because this was great news for China, not so for India. Of the $151 billion of trade between the two was made up of $132 billion of exports to India from China and just about $20 billion of imports by China from India. So 132 versus 20. It was a one-way street. China was flooding Indian markets even as it became, as the ambassador says, largest trading partner. Now, these two pieces of information on FDI on trade tells us how asymmetric China-India economic relations are. India makes minor tweaks to its FDI rules, thinking that it'll bring Chinese investment, while China has no such interest and it doubles down on its exports to India. India must export a lot of critical things from China: electronics and electrical equipment, about 40 to $50 billion, machinery, $27 billion, organic chemicals, 12 to $13 billion, plastic, steel, medical equipment, and so on. These are critical products without which the Indian economy would not be able to function. Alternative sources exist for some, but at a much steeper price. Moreover, China has diversified its supply sources, so even if India does not get its goods directly from China, Chinese goods would certainly come to India from other countries, such as Southeast Asian nations where China has manufacturing bases now. FDI side, the cumulative overseas investment stock of roughly 3 to 3.5 trillion and annual outflows in the range of 160 to $190 billion. China is a major FDI player globally across virtually every single region. Asia absorbs close to two-thirds of 70% of China's outward investment, or roughly $2.2 trillion so far. In these economies, Chinese firms have not just invested capital, they've transplanted entire manufacturing ecosystems, particularly in electronics, textiles, electric vehicles, and intermediate goods. These investments often are export oriented and deeply integrated into global supply chains, effectively extending China's industrial base into neighboring geographies. Latin America represents China's second major destination, with cumulative Chinese investment estimated in the region of 300 to 500 billion. The earlier phase of engagement was dominated by resources extraction, oil in Brazil, copper in Chile and Peru, but more recent outflows have targeted renewable energy, electric mobility, and logistics infrastructure. Europe, while much smaller in share, still has absorbed between 100 billion to 200 billion in Chinese capital, with a shift from earlier acquisitions of industrial and technological assets to more recent investments in electric vehicle and battery manufacturing, particularly in Eastern Europe, such as Hungary. Africa, though accounting for a smaller share, perhaps 50 to 100 billion in cumulative terms, occupies a strategic position. Chinese investments here are closely tied to resource security and infrastructure development, often under the framework of the Belt and Road Initiative. Mining, energy, transport corridors dominate this investment, creating long term linkages between resource rich regions in Africa and Chinese industrial demand. That leaves us only with Middle East. Meanwhile, it is also emerged as a very fast-growing destination, attracting multi-billion-dollar annual investments in energy, petrochemicals, and increasingly renewables. What about Chinese FDI into India? Just 2.5 billion, or 0.32% of India's cumulative equity inflow since 2000. Even if one broadens the definition to include venture capital investments and indirect flows routed through third countries, the total rises to only about 15 to 20 billion. The reason is very simple. India cannot make up its mind whether it wants Chinese FDI, which it suspects could undermine its sovereignty and weaken its self sufficiency drive. China's outward investment is frequently intertwined with industrial and geopolitical objectives. Dependence in critical sectors, whether batteries, telecom equipment, or APIs, that is, the chemicals that are required to make the drugs, active pharmaceutical ingredients, can translate into vulnerability, especially in periods of geopolitical stress. But caution, hesitancy, and irrelevant policy tweaks are not a policy option. The real option is to learn from the Chinese themselves how they handled FDI when China was growing, when China was reforming 20, 30 years ago. Beginning in the 1990s and accelerating through the 2000s, China actively courted foreign direct investment in technology from Japan, from United States, from Germany, and other parts of Europe. And this period was known as reform and opening up period. China did not see foreign capital as a threat. It saw it as an instrument of transformation, provided the state retained strategic control over the direction. Multinational corporations were often required to form joint ventures, localize production, and in many cases transfer the technology. The phrase bring it in of that period, which is yin jing lai or whatever the Chinese phrase is, I can't pronounce it properly, but it means bring it in, captures that mindset. To take full advantage of this, special economic zones provided infrastructure, policy stability, and export incentives, enabling China to integrate into global manufacturing networks and develop supplier ecosystems, skilled labor pools, and process expertise. China used this phase to absorb technology, build domestic champions just like Korea had done before, Taiwan had done, and Japan had done before, and gradually move up the value chain by investing in science and technology. Because China, the four major modernizations were agriculture, and defense, industry, and science and technology, which was very, very distinct focus of learning by doing and going up the value chain. Eventually, China became both an exporter and an investor in its third phase, which is the go out phase. So the first phase was opening up, which is the second phase was bring it in, and the third phase was go out phase, which is export and FDI. Before China, as I said, Japan, Germany had demonstrated a similar strategy of importing foreign technology, absorbing it, and becoming world champions. India has to do exactly this. But for this, it has to build a system in which firms, finance, and state all pull in the same direction towards production, technology, scale, and competitiveness, regardless of the source of FDI. But even before that, there must be clarity of objective. India often tries to pursue multiple goals simultaneously: self reliance, export growth, domestic champions, revenue raising, and low consumer prices, without clearly ranking them and thinking through where should we put our first emphasis. Successful industrializers made a clear choice: production capability first, and then everything else. And everything falls in line to build very, very strong domestic production capability. If we keep pussyfooting about China's FDI, we are not going to learn anything from them. This is a good opportunity for us to see what they did and see how best we can imbibe. But when will we even start doing that? I have no idea. Thanks for watching, and do share and subscribe.